Bank of Montreal has been caught with their pants down many times in the past, so should we expect this in the future crisis that is coming? That's what we're going to be digging into, and we're going to be looking at the history of what's gone on with BMO. BMO is also the bank, by the way, that has the highest amount of uninsured deposits in Canada. So they are the most exposed to a bank run. So that's something to also bear in mind. They also have a massive exposure to derivative products as well. So anyway, Canadian banks failed to capitalize on volatility, says Fitch, and this was June 2020. So we're journeying back in time to take a look at this. I may butcher this because, anyways, but Bank of Montreal's capital markets division reported a quarterly net loss, Fitch noted, as strong results in rates, foreign exchange, commodities, trading, and cash equities were more than offset by declines on equity-linked notes and widening spreads. So my question is, have they still got these equity-linked notes? And did they add more exposure during the risk-on environment that we experienced in 2020 and in 2021? Because this was in June 2020, and then we had the massive bull market that really started around this sort of time in 2020. So it's an incredibly important question to ask, and I would say yes, they probably did add exposure to that. So what is that going to mean in the future when we see these widening spreads happen again and when we see the equity markets sell off? So are they a bank that is massively exposed to this, because they were kind of the odd one out in 2020, and it's not the first time either that they've been caught. So let's continue on and see what they're saying here. So Fitch also said they pointed out the Canadian bank's exposure to complex structured products as a weakness in their markets businesses. Similar to some large European central banks, I wonder if they're talking about Deutsche Bank and Credit Suisse. Similar to some European banks active in global markets, some Canadian banks reported elevated losses related to structured equity derivatives positions during the most recent quarter, highlighting the vulnerability of these relatively complex products to material and prolonged deterioration of market conditions, it said. And we don't know what exactly those products are, but we've just got to guess now, have they increased exposure to them since then during this risk-on environment that we experienced? And the likelihood is yes, because it's not just in 2020 that BMO has ran into massive trading losses. They also ran into massive trading losses in 2007 as well, which we'll go through right now. So massive BMO trading loss should be a wake-up call, but it wasn't, because they had a massive one in 2020 as well. And the question would have been, would have that had a material impact on their business hadn't it been for the massive liquidity injection from the Fed and the Bank of Canada that happened in 2020 preemptively? So let's see what it says here. So we'll scroll down. This is May 2007. At this point, it's not entirely clear what went wrong in BMO's trading operation. BMO is investigating potential trading irregularities, and early on, BMO's new president and CEO, Bill Down, attributed the trouble to decisions that didn't adequately recognize the vulnerability of the portfolio and changes in market volatility. It's interesting because it sounds incredibly similar to that 2020 report, and I've linked both these articles in the description as well, so you can go over them. And considering everything that is going on in commercial real estate, doesn't it beg the question of how many derivative products are created on top of this commercial real estate, and how much exposure do the banks have to that? And we know BMO is one of the banks that has massive derivative exposure in Canada. We just don't know the details of what exactly the derivative products are, but we do know that they caused a loss in 2020. So that's really interesting to know. And another thing that I want to show you as well when it comes to BMO, which is kind of weird, and I saw this in 2020 and I was scratching my head about it then, they came out and launched this BMO Canadian Mortgage-Backed Security Index ETF. Now, the volume that trades on this is very, very light, and as you can see, it's performed marvelously going down in value. But that's really due to the tightening of the Bank of Canada and also the Federal Reserve. But what this is essentially is it's an ETF where you can buy a slice of mortgage-backed securities. That BMO has created this product, and you can read the prospectus on the product, which shows you the different type of mortgages that are in there. Most of them are insured by guess who? You and me, or should I say me and you? But anyway, that's just the reality. So they're all insured by us. So if they go wrong, if this goes wrong on top of that, you know, that creates potential losses for the taxpayer, and it creates contagion that can go throughout the financial system. Because if you think about it, who might have been buying this in 2020, because the yield really hasn't changed substantially since then, is pension funds, of course, because they were the ones who were getting pushed further and further out on the risk curve, and they invest a lot anyway in mortgage-backed securities because it's so safe. And we know also that the Ontario Teachers Pension Plan, they own Canada Guarantee, which is a subprime insurance agency for mortgage-backed securities. So, I mean, when you really think about how everything's connected in the financial system, this just doesn't sound or look good. And when they launched this in 2020, I just thought that was a bizarre time to launch a product like this, considering what was happening then. But then, of course, we knew that actually this was the start of a massive boom in the stock market, and it was the start of a massive IPO craze and all of the rest of it, right? But the thing is, there were loads of products, not just this product, and BMO could be on the hook for many, many more derivative products just like this one that got created in 2020 to take advantage of the fact that pension funds and large pools of money were just looking for places that they could park money and just get any type of yield. I mean, that was just the reality. It was so difficult to get a yield. And you know, another warning sign that I saw when I've been looking into this commercial real estate landscape, we obviously know that Calgary is suffering massively. And, you know, when you look at Calgary's vacancy rate, it's gone up since then. This article is actually from 2021. But, you know, Calgary is sitting at depressionary era levels of office vacancy rates, but the economy's booming. Yeah, those two don't really add up, do they? And really, that's the thing. I think this stimulus money has distorted the economy so much of the places that had the highest unemployment, because that's where all that stimulus money headed to and found its way into those markets. So they got the most distorted out of all the markets in Canada. And those were a lot of the cities which are across the prairie provinces. So I think it's really interesting because this is a sign that the underside of this economy is actually just on fire. It's falling apart. There's nothing there which is really supporting it. The foundation is just completely collapsing. So anyway, it's really interesting, but depressionary era levels, I mean, I just find that insane when you really think about it. And when it comes to the commercial real estate landscape, I know everyone's bored of me talking about commercial real estate, but I really think this is so profound, because when you even compare the Canadian vacancy rates to the US vacancy rates, the Canadian office vacancy rates are way higher than the US one. In fact, the worst city in the US, Calgary, is double that. Double the worst city in the US. And Calgary, the population of the city, is actually much larger than that city that is double of in the US. So it's kind of insane when you really think about what's going on in commercial real estate and how much exposure that some of these banks might possibly have. And one of those banks that has tripped up a couple of times in the past, which has come right by global financial crises that have happened, is BMO. And we got to look at the other banks. We've got to dive into what's going on with them, and we will do that. So anyway, I want to thank you so much for watching, so much for being here on this live stream. If you've enjoyed this, you might like either of these videos right here. And I will see you in the next one. It's been an honor to have you here as a viewer. Take care.